Welcome to the deep dive. Today we are jumping right into the Q2 fiscal year 2026 earnings for one of the biggest med tech companies on the planet. And we have quite a stack of sources here. We're seeing everything from huge product launches to some pretty massive strategic shifts. The narrative that's really emerging from this quarter, it isn't just about beating expectations. It's about a company that is hitting the accelerator on growth, and they're doing it with some truly breakthrough medical technologies.
Exactly. And our mission today is to move beyond that strong financial headline, which, is compelling all by itself, and really identify the strategic drivers. We need to figure out which of these newly commercialized technologies are actually responsible for this momentum, and more importantly, if that momentum is sustainable for the rest of the fiscal year.
Let's anchor this with the financials first. So the company reported 5.5% organic revenue growth and 8% earnings per share, or EPS, growth. Both were well ahead of expectations. And that confidence is so high, they immediately raised their full-year FY26 guidance.
And that raised guidance is the key signal here. I mean, they're now guiding for 5.5% organic revenue growth and tightening that EPS range up to, $5.62 to $5.66. When a company this massive does that, they aren't just looking at, short-term tailwinds. They're signaling that the whole structure of their portfolio, these new products they've spent years and years developing, is finally delivering.
So this is execution.
It's all execution. It's driven by really robust global procedure volumes and, frankly, highly successful, aggressive launches of these new products.
Okay, let's unpack this financial scorecard then. Let's start with that big number, $8.961 billion in worldwide revenue. Where'd that come from geographically?
Well, what's so interesting is the clear global demand. The U.S. organic revenue growth was solid, don't get me wrong, up 4.8%.
Which is good for a market that size.
Absolutely. But the international markets were the real overachievers here. They were up 6.2% organically. That spread, that difference, it really confirms that this new innovation portfolio is resonating across all kinds of different healthcare systems, not just here at home.
And from an efficiency standpoint, I noticed a very deliberate trade-off they're making in their spending. They managed to expand their adjusted gross margin by 70 basis points, which is huge thanks to cost of goods sold efficiency programs. But they didn't just let that margin drop to the bottom line, did they?
No, they didn't. And this is where you can see their strategic commitment to future growth so clearly. They achieved that efficiency, but then immediately chose to aggressively reinvest it. Adjusted R&D spending jumped 9%, and they significantly increased their sales and marketing spend, all targeted very strategically at these new high-potential growth drivers we're about to get into.
So they're basically saying, look, we had a strong quarter, we'll take the EPS beat, but we believe in this product pipeline so much that we're going to sacrifice a bit of immediate profit to make sure we absolutely maximize market penetration.
Precisely. They are buying future market share right now, but we have to acknowledge the pressure this creates.
Yeah.
That raised guidance for the full year is completely based on the idea that growth will accelerate even more in the second half. If these new product launches stumble or, if a competitor moves faster than they expect, that aggressive investment could suddenly look like a pretty big risk.
It really sets the stage for a dramatic second half. Okay, let's move to the engine room, where that acceleration is already happening. Cardiovascular. This segment delivered $3.436 billion in revenue, posting a spectacular 9.3% organic growth. For a segment this mature, this massive, that kind of number is almost, it's almost unheard of.
It speaks volumes. And if we drill down even further, we find the single greatest driver here, cardiac ablation solutions, or CAS. This franchise, on its own, showed a monumental 71% growth year over year globally.
71%.
And in the U.S., that growth hit 128%.
128% is it's explosive. But let's talk about the why. What makes their post-field ablation, their PFA portfolio, the Sphere 9 and the Pulse Select catheters, so disruptive?
Well, PFA is a true breakthrough because it's non-thermal. Unlike the traditional methods like radiofrequency or cryoablation, which, use heat or cold to scar heart tissue to stop arrhythmias.
Like atrial fibrillation.
Exactly. PFA uses these microsecond pulses of high-energy electricity, and the genius of it is that it's highly specific. It targets and ablates just the cardiac tissue while pretty much minimizing any damage to the structures next to it, like the esophagus or the phrenic nerve.
Which is a huge deal for safety.
A huge deal. It improves safety and it shortens procedure times, which makes it incredibly appealing to physicians.
And the company's clearly betting the house on this tech. They've cited a goal to add an incremental $1 billion in revenue just from this one franchise. That sounds incredibly aggressive.
It is aggressive, but I think it's achievable because PFA is just pulling so much market share. They have a massive first mover advantage with what is, right now, a superior technology. That billion-dollar goal tells you they believe they are rapidly changing the entire standard of care for cardiac ablation.
And that momentum isn't just isolated to PFA either. Within their cardiac rhythm management business, we saw high teens growth from the micro-leadless pacing systems.
Yep, the miniaturized pacemaker implanted right into the heart. And on top of that, the Aurora EV-ICD, which is their extravascular defibrillator system, that grew nearly 80%.
And Aurora is another one of those innovations that's really focused on patient comfort and reducing complications, right? Because the lead is placed outside the heart's vascular system.
Exactly. And then you turn to structural heart, another huge segment, and they're seeing high single-digit growth there, too, driven by their Evolut FX Plus TAVR system.
The TAVR system also just got an expanded indication. What does that expanded Redo-TAVI indication actually mean for patients?
It means they can now treat a whole new segment of people. So TAVR is transcatheter aortic valve replacement. A Redo-TAVI means the procedure can be used on patients who already had a valve replacement that has now failed.
Oh.
Yeah, this is a very complex patient group, and getting FDA approval here just significantly widens the available market for what's already a very successful product.
Okay, so that covers the core strengths. But now we get to where the company is really starting to see the returns on those huge R&D bets. They're tackling these massive, previously inaccessible markets, and it starts with hypertension.
This is the big one. This is the enterprise growth driver.
Oh.
The Simplicity Spiral Renal Denervation, or RDN system. This system treats uncontrolled hypertension, and this past quarter, they just cleared the final regulatory hurdles that transform it from a promising technology into a real commercial market.
Let's zero in on the biggest unlock there. The final national coverage determination, the NCD, from US CMS. Why is that one specific milestone so absolutely crucial?
Because it is non-negotiable for success in the U.S. healthcare system. CMS is the Centers for Medicare and Medicaid Services. A final NCD means CMS has officially determined the RDN procedure is reasonable and necessary for the Medicare population.
So that decision basically unlocks national coverage.
It unlocks coverage and, more importantly, it guarantees payment for treating our largest patient pool, the elderly, who often have the most severe and uncontrolled hypertension. So it's not just a medical clearance, it's a financial green light for the entire market.
And the commercial payers followed pretty quickly.
Very quickly. They secured coverage with major private payers, HCSC regions, key Blue Cross Blue Shield plans, which added about 30 million covered lives.
So if you put public and private together,
you're looking at about 90 million covered lives total in the U.S. That's about 25% of the entire population, and they did it in record time. This is what we mean by aggressive commercial execution.
And that commercial viability is so key because the scale of this problem is just huge. I think the number is 18 million people in the U.S. alone with uncontrolled hypertension. It's a multi-billion-dollar opportunity.
And that's just the U.S. market. RDN addresses a major societal health crisis that leads to strokes, kidney disease, heart attacks. Launching this moves them into the cardiologist's office, outside the OR, tackling chronic disease management in a way they really haven't before.
And they doubled down on that strategy of entering huge new markets with the AltaViva implantable tibial device.
Yes. So this device, it just got FDA approval for treating urge urinary incontinence. And again, we are talking about a huge underserved patient population here. Over 16 million people in the U.S. are affected by this condition. So what you're seeing is the rapid commercialization of two enormous new markets, hypertension and incontinence, both of which are slated to provide some very significant revenue acceleration in the second half.
We should also briefly touch on neuroscience. It saw 3.9% organic growth. It's a respectable performance, driven by some strong high single-digit growth in neuromodulation.
Right, particularly with the Percept RC-DBS system, which has that BrainSense technology, and also the Inceptive SCS system.
That BrainSense tech is vital, isn't it? It lets clinicians actually capture and record brain signals for personalized patient care.
It's continued, steady innovation. And, the overall neuroscience segment is also where the pelvic health unit sits. And that's where that AltaViva commercial launch is kicking off. So it's yet another new entry point for them.
Okay, that brings us to our last section, portfolio management and robotics. Let's start with the Hugo robotic-assisted surgery system, the RAS system. We often talk about how many systems are installed, but the real metric is utilization.
Utilization is paramount. It's everything. It proves that physicians are adopting it and that the system is effective. And Hugo is seeing double-digit utilization growth. They also just posted positive data from their Enable hernia repair study, which met its safety and effectiveness endpoints. That's essential for proving the system's clinical value. And they've initiated the Embrace Gynecology study in the US, which will just broaden the system's applicability even further.
So robotics is clearly a major long-term driver. But the biggest strategic news of the quarter really involved the planned separation of the diabetes business.
This is a major structural shift, and it's designed specifically to unlock shareholder value. The company plans to separate the diabetes business into a new standalone public company called MiniMed by the end of calendar year 2026.
Why do that? I mean, why separate a business that, despite being mature, is still growing? Diabetes grew 7.1% organically this quarter. Why carve it out now?
It's a classic portfolio management strategy. So when a massive, diversified medtech company holds a high growth but operationally distinct unit like diabetes, that unit's growth rate often gets, well, it gets diluted within the larger company's slower overall growth.
Right, it gets lost in the average.
Exactly. A standalone, pure-play diabetes company that's focused only on pumps and CGM, it often commands a much higher valuation multiple from investors who specialize in that fast-moving sector.
So MiniMed gets a higher valuation. But what are the risks with their preferred path here, which is an IPO followed by a split-off?
The risk is really the loss of operational synergy. Right now, the diabetes unit benefits from the parent company's huge R&D resources, their supply chain efficiencies, their global sales infrastructure. Separating means MiniMed will have to build those capabilities on its own and quickly, which is costly, and it introduces a ton of operational complexity. The IPO raises the capital they need, and the split-off is a clean way to distribute shares. It's a high-stakes, high-reward move.
And despite all this separation planning, the underlying diabetes business is performing really well. As we said, 7.1% organic growth driven by pump sales and the increasing attachment rate of CGM.
Yes, and key clearances are fueling that growth. The FDA cleared the MiniMed 780G to integrate with the new Instinct sensor, and they got pivotal approval for its use in the huge type 2 diabetes population. So just like the rest of the company, this unit expects to accelerate in the second half, driven by upcoming launches of new sensors like Simplera Sync and the Instinct.
You know, this quarter feels less like just a series of financial results and more like a detailed account of flawless execution on years and years of strategic planning.
That is the perfect way to summarize it. This success is not accidental. It's rooted in incredibly aggressive execution across those newly commercialized enterprise growth drivers we talked about. You've got PFA redefining cardiac ablation, Simplicity unlocking the massive hypertension market, Hugo establishing itself in robotics, and Altaviva opening up pelvic health. These products are delivering this outsized demand that is driving revenue acceleration today.
So the key takeaway for you, listening to this, is the sheer confidence the company is showing by reinvesting so heavily. They are choosing acceleration over immediate profit maximization. That 9% R&D hike and the ramped-up sales spending, that's all deliberate. It's a huge commitment to maintaining this momentum well beyond fiscal 26.
It signals a belief that their competitive advantage, especially in PFA and RDN, is durable, and they know they need to press that advantage now before their competitors can catch up. It is a long-term, calculated risk.
And as we close this deep dive, let's just step beyond the immediate financial dimensions of all this growth. With such an intense focus on innovation and, manufacturing all these complex new technologies, it's worth noting that the company is also focusing on the environmental dimensions of their operations.
Yes, their non-financial goals are just as ambitious. To match the scale of their medical innovation, they have committed to achieving net carbon neutrality across their operations. That's Scope 1 and 2 by fiscal year 2030.
And they didn't stop there. They also raised their targets for reducing operational waste generation intensity to 40% and also for energy use intensity. When a company is aggressively expanding its manufacturing footprint to meet this kind of acceleration, these sustainability goals become equally challenging. It really adds another layer of depth to what growth means for a leading global medtech player. It's not just about the pipeline, but the entire operational footprint of that pipeline.
Which raises a fascinating thought for you to consider. As the healthcare sector embraces more of these complex, cutting-edge devices, many of which require sophisticated materials and really intricate manufacturing, how much pressure will investors and regulators start to place on ensuring that the pursuit of health innovation is also coupled with really aggressive environmental stewardship?
Great question to mull over as we watch this acceleration unfold in the second half of the year.